Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. We've got an exciting lineup for you, with a focus on some of the biggest names in the industry. From SAIC to NVIDIA and from Technoglass to Cadent, we'll be exploring the latest trends and analyzing the numbers to give you a clearer picture of what's going on in the market. Let's start with SAIC, which has seen its stock price drop by 23.4% over the last 6 months. Our analysts have been taking a closer look at the company's performance, and they've identified 3 key reasons why SAIC might not be the best bet for investors right now. Firstly, the company's long-term revenue growth has been disappointing, with an annualized growth rate of just 2.2% over the last 5 years. Secondly, revenue projections for the next 12 months are looking gloomy, with analysts expecting a drop of 2.3%. And thirdly, SAIC's free cash flow margin has been declining, dropping by 2.5 percentage points over the last 5 years to just 4.7% in the trailing 12 months. On the other hand, we have companies like NVIDIA, which has seen its stock price soar by 1,545% over the last 5 years. And then there are lesser-known names like Technoglass, which has delivered an impressive 1,704% return over the same period. These success stories are a reminder that there are always opportunities to be found in the market, even in uncertain times. We'll also be looking at other companies, such as CBIZ, which has seen its free cash flow margin drop by 9.6 percentage points over the last 5 years, and First Science, which has reported a 23.8% annual EPS growth over the same period. Our goal is to provide you with a balanced view of the market, highlighting both the potential risks and rewards. As we navigate the complex world of stocks and finance, it's essential to stay informed and up to date on the latest developments. That's why we're here to bring you expert analysis, insights, and commentary from the world of finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a fascinating story that's been making waves in the world of trade and economics. It appears that U.S. President Donald Trump has been floating the idea of a $2,000 dividend payment to every American, excluding high-income individuals, using revenue generated from tariffs. This proposal has sparked a lot of debate, with some experts questioning the math behind it. According to estimates, tariffs are expected to generate around $300 billion to $400 billion annually, and over the next 10 years, they could produce a whopping $3.3 trillion in revenue. However, as Trump's administration told the Supreme Court, tariffs are not meant to generate revenue, but rather to rebalance trade. This seeming contradiction has raised eyebrows, and many are wondering how this dividend payment would be funded. Treasury Chief Bessent has suggested that the dividend could come in various forms, including tax decreases that have already been signed into law. This could include deductions such as no tax on tips, overtime, or Social Security, as well as deductibility of auto loans. While this might not involve fresh allocations, it's essential to consider the budgetary implications and potential impact on the federal government's finances. Meanwhile, Swiss watchmakers have seen a rise in their shares due to optimism over a possible reduction in Trump tariffs. The U.S. president has announced that he's working with Switzerland to lower the 39% tariff rate on exports, which has been in effect since August. This development has brought some relief to companies like Richemont and Swatch Group, whose shares had fallen after the tariffs were imposed. As we continue to navigate the complexities of global trade and economic policies, it's crucial to stay informed and consider multiple perspectives. The implications of these decisions can have far-reaching consequences, affecting not only businesses but also individuals and communities worldwide. Welcome back to the Riskwiser Zone. Today we've been exploring various stories that impact our investment decisions and risk management strategies. As we close out this episode, I want to bring to your attention a thought-provoking narrative surrounding the future of Berkshire Hathaway after Warren Buffett's eventual departure. The recent downgrade by KBW, rooted in succession anxiety, highlights concerns about Berkshire's ability to sustain performance without Buffett's leadership. However, it's essential to remember that Buffett hasn't been making decisions alone. His cohort, including Greg Abel, has been instrumental in shaping the company's operations for years. Abel, who will take over as CEO, has overseen Berkshire's non-insurance operations since 2018 and has earned the trust of many within the company. The idea that Berkshire's success is solely dependent on Buffett seems short-sighted given the strength of its diversified model and the experience of its incoming leadership. One key element that will undoubtedly influence Berkshire's future potential is its enormous cash pile, now sitting at a record $381.6 billion. This war chest provides Berkshire with unmatched flexibility in deploying capital during market downturns or periods of economic stress. The company's conservative approach to investing in recent years may be setting the stage for significant opportunities under new leadership. While it's true that investors might be less eager to pay the Buffett premium for his investing prowess, leading to a slow moment for the stock, it's crucial to consider the long-term perspective. Berkshire's strength lies in its structure, a collection of durable, cash-generating businesses led by disciplined capital allocators. Uncertainty often breeds fear, but with the capital at its disposal and a cohort of investors who have learned from one of the greatest investors of all time, I believe Berkshire has a bright future ahead. Buying on weakness might make sense for those with a long-term mindset, as the company's fundamentals remain strong. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.